Good afternoon, and I'm Robin Hall, and welcome to our Foundation Home Loans and Mortgage Introducer. With the coronavirus crisis showing little sign of abating and with the country still in lockdown, this afternoon we're going to be looking at the new abnormal. I'm joined today by Hans Gaberbauer, Chief Executive of Foundation Home Loans, and its Head of National Accounts, Grant Henry. They're here to answer questions about the situation lenders find themselves in, and of course, those of brokers and borrowers during the current market. Again, we've had hundreds of questions submitted and we're going to be trying to cover as much as possible over the next hour. If you've registered your details and submitted a question and we don't get around to covering that today, the team at Foundation will endeavour to help reply to you directly. But to start us off, let's begin with Hans. Hans, can you give our audience a brief explanation as to why lenders like Foundation Home Loans have had to withdraw from new lending?
Absolutely, and obviously the reasons may differ from lender to lender naturally. In our case, the decision to suspend lending was driven really by three factors. The most immediate one was the lack of internal surveys once the lockdown kicked in, because our current criteria and our current funding requirements do need internal surveys. The second one was the introduction of the mortgage payment holiday scheme, which, if you recall, actually came in slightly before the lockdown, obviously in preparation of the lockdown, but with actually very, very, very little consultation, at least for the non-bank mortgage lenders. So we got about 6 hours notice. That very quickly raised some serious concerns for us, especially around cash flow, but also the operational pressure it would put us under as people would start calling in even in advance of actual payment issues, and therefore obviously driving much higher call volumes than we would ordinarily expect. And the third reason that caused us certainly to suspend lending for the time being was unclear pricing. So we're a wholesale funded lender. That means our pricing ultimately reflects what we can achieve in the securitization market when we securitize these loans. The securitization market certainly is in abeyance. There have been a few trades where, in fact, some of the prices observed in an illiquid environment were more than twice as high than what we would have had just prior to the crisis. And in that uncertain pricing environment, we also felt that we didn't really know how to price these loans for the time being. We're beginning to see that settle down, so that will change. But these were the three drivers we had: no internal surveys, the mortgage payment holiday scheme, and the uncertainty around pricing.
Now, Grant, we've heard a lot about mortgage payment holidays in both the national and trade press. Do you think the general public actually have sufficient knowledge about what a payment holiday actually entails and what that will do to the final loan amount that will still need to be repaid?
Thanks, Robin. I mean, let's be honest, not one person truly saw this happening to the speed and to the extent in which it did. I mean, I think the 18th of March, the announcement came from the government saying that lenders will be giving 3 months payment holidays. And I think when you look, that's 3 weeks ago. And in that time, between probably 15, 25% of mortgages have now exercised that facility. So with a normal payment holiday, lenders would go through a normal due diligence process and assessment on their customers. And this time round, it's 5-10 minutes and they've instantly got this payment holiday. So the vetting's changed on that. Now, I think we have to give complete credit to every lender who has managed to step up and to be able to handle this. But I think if you look at it knowledge-wise, from a customer's point of view, I think there are those who desperately need a payment holiday. And it served its purpose. But there is a large proportion of those who saw the holiday and the opportunity there. And I think they did take advantage of that situation without looking at the bigger picture.
So Grant, are you saying, do you think there might be some borrowers and landlords that are looking for a payment holiday when they don't actually need one?
Okay, let's start by saying that the government's ability to allow customers to take a payment holiday was 100% the right thing. But I think it's almost created 3 categories of customers off the back of this. So you're first those customers who are desperately in need, maybe your self-employed customers, those who instantly lost their jobs, and straight away the need for a payment holiday was required. Then you've got this second group, and I've called these like the loo roll group. These are those who have jumped on the bandwagon, whether it be through social media, whether it be through family and friends that they've spoken to, who don't have financial experience, and they've seen it potentially as free money in a way, and it isn't at all in any way, shape or form. So for those, there's clearly no necessary benefit for them apart from this short-term fix for them of kicking the can down the curb and worrying about it in the future. The third group is what is fallen into our space, and we've noticed a lot, where you have the opportunists. So these are people who are looking at the gaps in the market at the moment and saying, actually, if I can capitalize and sit on this money for the next 3 months, I can use that to take advantage of something else, whether it be in the stock market, whether it be trying to grow their portfolio, whatever the circumstance may be. So they're your opportunities, trying to take advantage of a bear market. But so, yeah, in my opinion, this has happened too fast for customers to really understand the implications of it. And that's where the need for mortgage advisors to be speaking to their customers now, just to speak to them about what they actually wanted or what they requested is fundamental. It's very, very important.
I just want to go back to Hans here. Hans, what do you think the impact would be in that scenario where people are just taking the payment holiday because they can?
Well, quite a number of people, quite a number of members of the public certainly got that impression based on the government, the way the government phrased the mortgage payment holiday scheme. The FCA has been a good deal more differentiated in their statements and their guidance to the lenders who are FCA regulated, which is almost all of us. So it's not a straight through like entitlement, and certainly not for straight through 3 months, 100%. If everybody took it up for 3 months at 100%, that would have a very serious impact on lenders' cash flow. Obviously, one of our key sources of cash flow is the difference between the interest rates we charge and the interest rates we have to pay on the funding that we raise in order to fund the loans. It's really fairly basic. In our case, if every single borrower that we have on the books and on the sheet suspended their payments, our net cash flow impact would be £11 million per quarter. That's a chunky amount of cash that I would have to raise someplace else. And obviously, I'm not a deposit-taking institution, so I don't have access to some of the standing schemes for banks and building societies. Now, we're not seeing that level of take-up. We're monitoring that incredibly carefully. We are having conversations with every single one of our borrowers. Clearly, the FCA has actually given us effectively a safe harbor from MCOP 13, which is how one usually addresses arrears and forbearance situations. So we can deal with this faster. We don't have to worry so much about getting evidence. But certainly in some cases, we are looking for some more searching conversations. And occasionally we're pushing back where we can clearly see that there's really no need at all. And somebody's just looking to basically hoard liquidity, but like what Grant was saying about the loo roll brigade. Some people hoard loo rolls and other people hoard cash.
That's interesting. What do you think the situation will be going forward, Hans? Do you think payment holidays could be extended? And do you think lenders should be ready, or indeed would they be ready to embrace this if it was called for?
We are fully planning for a further 3 months extension. So we believe in the end the mortgage payment holiday scheme will be available for 6 months. That's our working assumption. That's how we're planning all of our scenarios, financial and operational. And if the government feels the need to do so, we would be fully supportive. I mean, as Grant was saying, the mortgage payment holiday scheme is actually a very, very, very good idea on the part of the regulator. If they had held us to MCOP 13, either normal arrears standards, there's no way we would have been able to deal with the level of impairment that people are now genuinely experiencing or are about to experience. And I think the mortgage payment holiday scheme was an absolutely necessary condition in order to enable the government to lock down the country, which obviously dramatically impaired people's ability to earn an income, especially amongst the sort of customers that we deal with in the specialist lending sector. So the mortgage payment holiday scheme is absolutely necessary. And if it's necessary to extend, we will completely support that. And we're already planning for that. My personal view is that the 3 months will not be quite enough in order to give people the best chance to trade through this, regain their full income earnings capability, and therefore their full ability to start paying their mortgages again in the normal fashion.
That's good to hear, Hans. There has been some government support from the lending community, but do you think that there should be more government support for non-bank lenders?
Well, As it happens, and I have to say, we have to take a good look and run quite a few numbers. We are in a fairly robust position. I'm quite comfortable for foundation home loans. That's partially because we have a significant back book, which on the one hand generates work, but on the other hand, long term also makes sure that we have significant cash flows coming in. It's partially because we have our servicing in-house, so we have actually been able to respond very quickly to this while still controlling our costs. The non-bank mortgage lenders have not really benefited from any specific scheme whatsoever. So we're in the same situation as every other company that isn't a bank or building society out there in the UK economy. At the same time, we are being held, quite rightly, to the same standard by the FCA, which is the conduct regulator for pretty much everybody, to deliver the same relief through the mortgage payment holiday scheme as the banks and the deposit takers. But we do not have access to the schemes that are generally available to those, including the implicit taxpayer guarantee for raising deposit finance from members of the public up to a certain amount, or indeed some of the additional schemes rolled out. I think if the mortgage payment holidays had to be extended for a very long time, and if the take-up was found to be extremely high, I think something would probably have to be done in order to avoid disorderly wind downs. Could the government do more? Absolutely. Should they do more? I think other people are in a better position to judge that.
Okay, I've had a couple of questions coming from Jeff Laird from Buy-to-Let Funding Services in the Southeast. He wants to know what you consider to be the biggest challenge, highly dependent on institutional funding. Hans, what would you say to Jeff?
I think there are really three things these types of lenders should focus on, and that certainly includes ourselves at Foundation Home Loans, being also wholesale funded. The first focus for us, and frankly for any business today, is around cash and cash preservation. We all need to be very, very, very careful about cash flow, have a real understanding of how much cash we have, how much is due to come in, how much must go out, and where can maybe moderate how much cash goes out, either in terms of time or amount, by taking appropriate actions. That's number one. And the key thing is around cash preservations, we don't quite know how long this is going to go on for. So the better you can preserve your cash and the clearer your view around cash, the longer you will be able to last as this extends itself. It's basically about creating runway. Number two is to rapidly analyze the capacity left in your warehouses once lending resumes. How much time do you have left in the warehouses? How much time do they have left to run? And of course, how much funding capacity you have. In Foundation Home Loans case, we've always planned for a significant disruption in the securitization market, not unlike what we're seeing today, what we saw after the initial Brexit referendum, for what we saw actually after the credit crunch. So our warehouses and our warehouse maturities and lines are actually structured precisely to allow us to trade through these situations. But everybody needs to take a close look, carefully manage these deadlines, and be in very close touch with their funders. And of course, now see conversations with their funders to adjust the criteria, because a lot of us in the specialist lending market certainly have criteria requirements that don't match a lockdown environment.
Okay, Jeff also wants to, and we've had quite a few similar questions to this. Grant, I'm going to throw this one towards you. Jeff wants to know if valuers will elect for the foreseeable future to take an ultra-cautious approach on property values, particularly on investment values for HMOs and multi-unit freehold blocks.
Good question. I would definitely say ultra-cautious, probably not. I think cautious, definitely, and that would be prudent for anybody in this time to be taking a prudent approach to risk when looking at valuations, and I think especially around investment values, definitely. So I think it's a fair comment, but yes, I definitely do see a cautious approach.
I think that'll change going forward. Grant, there seems to be quite a few people suggesting online here that the crisis will lead to more clients falling into the specialist sector. Is that something you would agree with?
100%. Yeah, I think if you look at what's going to happen off the back of this, you're going to have your self-employed customers that are going to fall into a gap that your high street banks just won't be able to handle. It just won't be built within their models. But for me, I think some of it is around what those customers are actually doing during this time as well. So manual underwriting will be fundamental in the way in which you assess these customers' needs and requirements at this point. And I think if you look back to 2010, when the specialist lenders came back, there was risk built within their propositions. So it'll be interesting to see how it looks this side. I do think that that's where there is going to be big opportunities for advisors going forward.
Well, talking about advisors going forward, without a doubt, this crisis is going to have a lasting effect on the whole of the UK. What kind of impact do you think it's going to actually have on the broker community?
That's a tough question. And honestly, the longer this goes on, it's sadly going to have an impact. But it's not just on brokers. I think it will be on lenders. I think it will be on surveyors, solicitors, and everybody within this chain, networks, clubs, etc. But what I would say, I mean, I've been looking at the numbers at the bottom, and there's still people joining. We're just shy of 300 people coming onto this call and onto this webinar. And that to me says a lot. It says that brokers want to know what's going on. They want to know what our position is. They're hungry for it. And that really excites me. So I think credit to everybody who's come on to these webinars at this moment in time. We want to make sure that we're giving back and supporting the intermediaries. But realistically, yes, it's going to be tough. But if we all roll our sleeves up and we work, we can certainly pull through this.
And let's hope so. Hans, COVID-19 has already seen the world change in many ways. What do you think? Well, do you think that we'll see a transformation to a more digital process in the future?
Yes, absolutely. And frankly, this is driving me to embrace with some of those topics a lot more than I have in the past. So clearly, locked-in is not just about valuations. Lockdown is not just about valuations. It's also about anything that typically has required or has been easier to do face-to-face, because face-to-face is basically now gone. There are some elements where I have to jump over my shadow. We've been lending for 20 years. We have some interesting experiences about what goes on. We know that a mortgage loan and the process of its origination needs to stand up in court sometimes 15, 20 years later, when questions are suddenly raised about what happened at origination. Until now, I've actually been, I'm outing myself as a dinosaur here, but I've been a little bit of the view that, for example, if you look at, you hand out mortgages without any face-to-face contact at any point with anyone. And you think, okay, so my average loan size at this point is £225,000. And you can't be bothered to see somebody just once, whether it's the solicitor or the broker, even though you want to have a £225,000 loan. Until now, I would have said, like, I don't need to have it completely frictionless and faceless, non-face-to-face. But yes, of course, this environment is going to phase me to change my tune, because otherwise I can't do business in the lockdown environment. And frankly, even when the lockdown is lifted, I've no doubt that some of these things we will then start carrying forward and continue to use. So yes, we will become more digital. The biggest challenge, incidentally, unfortunately, of course, is the legal process, which seems to be unbelievably resistant to change.
Well, that's an interesting point. I've got a question here from Steve Beckett from WB Mortgages, and he wants to know what you think the market will look like once physical valuations can take place again. Are we going to see much change, do you think?
Yeah, I think my current hunch is we're going to see higher pricing. So wholesale prices have gone up. So the prices at which I raise my funds. This is not to be confused with Bank of England base rate. That's just the price of liquidity. That's not the price of credit. So the price of credit has gone up, even as the price of liquidity has gone down. So I would believe that as lenders like Foundation and others come back to full lending suite, even if internal surveys are possible again, we're going to see higher pricing in the product ranges, at least for some time. And I also believe that at the margins, we're going to pull in our horns. We're going to be a little bit more conservative. We do reckon that this whole situation will result in a recession. Thanks to the government efforts, with a bit of luck, nothing too severe, but nonetheless, there will be a downturn scenario, and that will be reflected in our criteria, and I suspect our competitors' criteria as well. So it won't be coming back quite the way it was before, even if the lockdown is lifted and valuers can do their in-house, their on-site valuations again.
Well, indeed. I think the impact of surveyors being unable to complete valuations during lockdown, that has been huge. Grant, I've got a question here from Jeff List from Specialist Money. And he wants to know whether lenders and their surveyor partners will work on alternative methods for valuations being completed in the future. And if so, what do you think that process might look like? Do you have any thoughts on that?
Yeah, well, firstly, we are, and every other specialist lender at this moment in time, looking at opportunities, whether it be for a desktop valuation in AVM, and how that looks. And we're all in that same position. We've seen lenders find those solutions quicker than others. So yeah, we are very much looking at that space, and I think that will speed up the journey from application to mortgage offer, which is great. But as Hans said, the bit that's going to slow things down will continue to be the legal part. What I would add as well, that we've always done, and especially within our space in the specialist space, we've always done that face-to-face physical valuation, and we're still in properties that aren't habitable, and they're the reasons that we're declining some of these. So it's going to be interesting how we do it. So you're going to have to mitigate your risk on the back of that. So you're not instantly going to come in and be doing 80% LTVs or on certain property types. But I do think that there'll be an introduction into the AVM desktop space for lenders like ourselves, but that will happen sooner rather than later. And this has encouraged us, this has put us in this position. But we're also looking at EID as well, how we can embrace that. It's always been on our agenda, but there's always been something else in front. This has brought it to the forefront and put us in this position. So yeah, I think it's you will see the improvements through technology to streamline the application process up to mortgage offer.
Okay, I've got a question here from Richard Alton from Alton Mortgages. And he wants to know that given what we could see happening in China and the rest of Europe, why some lenders have been slow to react to not having a process set up for automated valuations when looking what was happening in Italy and obviously China, a lockdown was seemingly always on the cards. Hans, what would you say to Richard?
Well, if I'm honest, I don't really have much of an answer. I think it's a very fair challenge. I have the somewhat pathetic excuse that I believe we are in the good company of pretty much every other specialist lender, all of whom seem to have been similarly caught out. I'm happy to be be corrected on that. But I believe none of us anticipated this, and most of us incorporated internal inspections as part of our criteria, and therefore we're caught short by this. But I admit that that's a pathetic excuse. If we had been a bit more on the ball, we could have been more front-footed on that.
I think you're right. It did really catch everyone out this. Hans, what do you think in the long term? What is the impact on the buy-to-let market going to be?
Well, the answer to that question critically depends on how many specialist lenders make it through this crisis. If you wind back 3 weeks ago, just before the new abnormal kicked in and the old normal was still prevailing, we saw a consistent quarter-on-quarter increase in products being available for the whole of market, buy-to-let and owner-occupied, but especially buy-to-let. And we actually saw a fairly consistent, if sometimes quite gradual, reduction in margins. So more choice and keener pricing for advisors and their clients. And that was in part clearly driven by all the non-bank specialist lenders in the market and joining that market. Now, if a significant number of lenders of these cannot trade through this current situation and are unable to resume lending once this is over, you're going to see a lot less competition. And it's that size of the competition that will be one of the big drivers about how this market is going to come back, especially in the specialist buy-to-let part of the market. I think that's number one. I think number two, in terms of individual lending to buy-to-let landlords, I think there will be more emphasis on cash flow resilience. Looking at how to cover voids has always been a significant topic. Hence the ICR coverage traditionally pre to all the great tax changes at 125% of rental, and all these good things and protections. I think what this event is teaching all of us, not just the lenders but also the landlords and their advisors, is, well, maybe we need to plan for more severe scenarios. So, as I said, more emphasis on cash flow resilience. I think lastly, again, going a little bit back to the macro picture, I suspect quite a number of people will find their income earnings capability constrained after the crisis, they will not bounce back to the incomes they're enjoying today, especially people who are not on PAYE style employment. Some of these post-crisis may not be able to then access the mortgage market, and as a result of that, actually require accommodation from the private rental sector. So we may see some growth in the private rental sector, and therefore in the buy-to-let market as a result of that.
Okay, well, there will be severe consequences all around, and one of the issues is obviously repossessions. Now, while immediate protection has been put in place to put a halt to repossessions, do you see this figure increasing as those are eventually lifted and we return to a state of normality? Grant, do you have some thoughts on that?
Yeah, I think we've got to be realistic here as well. When you look at the money that is being pumped into making sure that people are in lockdown, there is the way it's going. The signs are there that potentially we will go into a recession of some sort, however that may look. And sadly, a recession and repossessions go hand in hand. But what I would say is that it is a lender's resort to do that. And I think that we will be working harder now than ever to make sure we are speaking to our customers as much as possible now to protect them and work with them at this moment in time. So, and that's where the brokers will also come in to really help the customers. So in answer to your question, I do think that you will see an increase in sessions, not to the same extent as before, but I do think there is a high probability that it will happen. I feel like I'm doing, sorry about that one.
That's unfortunate, but such is life. Now, Hans, Foundation was one of a few lenders so far that announced that they'd furloughed a number of staff. What was the rationale behind that?
Well, I was there during the great financial crisis. Like many people, I think, signed up to this webinar, and like many people amongst the our distribution partners, and we know and all remember how much fun that was, or indeed not. One of the big lessons I took away from that is if you have a sudden change in environment for the worse, the first thing you need to look at is your cash flow, and you need to immediately take cash flow preservation measures. Furloughing our staff was one way of making sure that some of our staff, obviously just over 60 out of 265, is one way of preserving cash. The other one was the suspension of lending to make sure that we retained all equity line funding available for potentially meeting OpEx expenses. And the reason is, as I said before, the critical factor in a situation like this is to create as long a runway as possible to allow you to trade through the disruption. The reality is nobody knows how long this disruption is going to take. We're beginning to see the impact of the mortgage payment holiday. And I'm pleased to say that on the whole, it looks like take-up is not as high as we have modeled. But it's difficult to model because, as I was mentioning earlier in the webinar, this has never been done before. We've never been in this situation before. So the numbers are early. I'm beginning to feel more relaxed about it. But until I have a much better view and a much better handle on how the mortgage payment holiday scheme is playing out for us and what ability we have to influence that in our conversations with our customers, I will be very conservative. And putting some of our staff on furlough quickly was part of that conservative instinct kicking in and making sure we have as much optionality as possible until we have a better sense of how this is going to play out.
Okay. Now, Grant, when things get back to some level of normality, do you think lenders will view self-employed how do you think lenders will view self-employed income in the future, given that current earnings for many have been, well, totally obliterated?
Grant, do we have you?
Oh,
apologies, I was on mute. Apologies. The bin men were going past the house, so I thought whilst they were beeping and doing rubbish. So, sorry, could you repeat the question again, Robin? Is that right?
Yes, sure. So when things get back to some level of normality, how do you think lenders will view self-employed income in the future, given that current earnings for many will have been totally obliterated?
Okay, so yeah, I mean, self-employed, we've got to proceed with caution. But I think one of the most important things, I mentioned it earlier, is that manual underwriting approach. Now, if you get an application for a self-employed person for the last 15 years, and you can see that their income has dropped, but they've still sustained quality of life and everything else is fine. They haven't been spending money erratically in any way, shape or form, and you then don't see arrears linking to it. Then to me, it shouldn't be as impacted as you would imagine. I think one of the other bits as well is how customers are looking at protection. And that's one of the things I can see us as lenders, not insisting it's insurance with us at all anyway, but I think it's an opportunity for brokers. But I would like to see more protection to see customers making sure they are protecting their mortgage and taking that a little bit more seriously than I've seen before in the past. I think if you look at a buy-to-let, we've got no minimum income on a buy-to-let mortgage at Foundation. And that's not a bad thing. If you've got a customer who's got a small income, but they have savings, they've got plans, they can present what they're doing, then that to me is a sensible business decision. So I think, yes, we must proceed with caution. I think there will be a lot more prudency within our underwriting approach, but I don't think it will be impacted as hard as it could be.
And if I may add to this, Robin, if that's okay, it really, as Grant was saying, it really is about, I think, the protection conversation, which we know a lot of advisors are already having with their customers and are trying to have with their customers. I think that's going to become even more important. Everybody must now understand how vulnerable their incomes are to events. And we don't always know what these events are going to be and how they're going to come about. Nobody predicted this crisis. People were caught out by the result of the Brexit referendum back in 2016. People were caught out by the credit crunch. The reality is incomes are never as certain as we believe them to be, especially, of course, if you're self-employed. As responsible lenders, we will have to take that into account. As advisors will owe duty, of course, to make sure that people get the right product and that it's a sustainable product. And a key part of that will have to be a higher emphasis on protection products. What are borrowers and customers doing to show that they are thinking about this and they're using part of their available spend to protect themselves and their financial liabilities, so they can actually themselves trade through situations like this, working with their lenders. So advisors, I think, have a huge role to play here, and arguably also a big opportunity when these conversations come back.
That's an interesting point, Hans. Do you think there will ever come a point where the mortgage will only be granted if a protection policy is in place alongside it?
I wouldn't rule it out. What I can rule out, at least for us, is we will never want to sell it. We're a lender. We're in the business of granting mortgage credit. That's our expertise. I have no idea about what the best protection policy is. That needs to be the brokers, and the brokers should source those from the best providers. So this is not about a rerun of PPI, but it is possibly about, just like a lender today will typically check whether buildings insurance is in place, at least at the point of completion, and then has fallback policies that protect the lender. We may start seeing similar checks maybe at the point of completion around income protection and other types of protection policy to know at least they are there. And in fact, I've already raised with some of our partners who also are in the insurance business about, okay, what fallback policies might I be able to take out as a lender to protect ourselves, just like we do for people who don't maintain their buildings insurance policy and where I have a financial interest only fallback policy. So I think, watch this space. I'm sure we're going to see some interesting ideas here, but also some requirements coming in.
Well, that's some big news for the protection industry there. And, history is littered with life-changing events. Zoe Jackson from Equitini Gateway, she'd like to know how long you think it will take for lenders to return criteria back to previous levels in a post-COVID-19 environment. Hans, can you see a fast return to this, or?
I think it goes back to the question the answer I gave to a different question, which is really how many lenders will survive through this crisis, especially at the specialist end, because that's how we create competition from which advisors and their customers have benefited so much in the last 5 years. If the crisis persists for a longer period, we'll probably see some lenders fall away. That means there's going to be less competition. So that's going to be one of the biggest speed drivers. If we're all back after a short, if painful disruption, then I think criteria will probably be driven back to a level not unlike what we've seen before relatively quickly. It'll take a little while because there are some learnings from this crisis. Risks we haven't previously assessed maybe quite as conservatively. We may look at more conservatively now, but as we just discussed in answer to the previous question, there will also be answers to that and products which can help us get back to the old criteria levels.
Okay. Grant, I've got a question here from Victoria Milne from Mortgage Advice Bureau. And she wants to know if Foundation is going to be coming back to the market with new products when new mortgage lending is resumed.
Yeah, I think it links in with what Hans just said just then, that we are looking at technology, AVMs, desktop proposition in the first place. So that will be our first hopeful introduction back into the market with a lockdown COVID-19 proposition. And then post the lockdown, we'll then be coming back into the market. But I think that you're going to see interest rates be slightly higher off the back of that to mitigate risk for us. And I would probably say as well that you're going to see, when we do come back into the market, that your higher LTVs, your higher risk stuff, like, for example, our short-term let proposition won't come straight back in. That's going to take a bit of time to get there. But it's a great question from Victoria, and believe me, we are itching to come back into the market. So thank you very much for the question.
I've got another question here from a broker called Simon Deeming, and he wants to know what you see as the key drivers to smaller niche lenders surviving this upheaval. Hans, I think that's one for you.
2 points, one of which I've already mentioned a number of times, which is a ferocious focus on cash flow. Know exactly how much cash you have, know exactly how much cash will come in and the number of scenarios and how much cash you need to spend and how can you influence the income and the outgoings such that you have the longest runway possible until normal business resumes. That's number one. Number two is keep your funders on side. It is quite possible that your current situation and the current market situation don't quite meet your funding requirements, so that technically your funding line, while it may exist, is not practically speaking accessible. So talk to your funders, take their temperature, really understand how they view the risks, how they view you as a risk, how they view the market as a risk, the individual loans that you're looking to lend, and see whether they would vary their criteria in order to for you to be able to continue to be in the market in a lockdown compliant manner. Those are the two items that smaller lenders, and to a degree that still includes us at our volume, really need to focus on, and in order to stay around.
Okay. Now the coronavirus has affected all walks of life, the rich and poor, and as we've seen with our own Prime Minister, it certainly doesn't discriminate. Grant, what do you think the impact on property prices will be? This has been a common question coming in from all sides.
Yeah, I mean, I'm no economist, so it's difficult really for me to say, and I'm reading the same articles that everybody else is as well. I mean, some of them are saying that you're expecting 500,000 property purchases to fall through this year, which is obviously going to have an impact on house prices. They're saying that house prices drop between 3 to 5%, and I'm kind of expecting that. That seems fairly realistic, but it's a tough one to really say, I think, at this moment in time, because we haven't hit the peak. That's the situation we're in at the moment, is we're still seeing the death toll going up, and we still haven't seen us on the way down and the recovery. The positive signs are coming from Spain, from Italy, that it is dropping, but it's not happening quickly. So the longer we're in this, the more damage it's going to have long term to the market. And then I think we are going to then obviously see larger drops in house prices below 3 to 5%. But that's the kind of numbers that I'm working to at the moment personally.
Hans, were you in agreement with that?
Yes, I don't think there's really much to add. I think Grant covered it off well.
Okay, we've got a question here that's coming from Will Lloyd from Brightstar Financial, and he wants to know what would be the one piece of advice you would offer brokers to do right now and not to do right now during this period. Grant, should we start with you?
Yeah, please. So I'll start with the not to do, because and that is to roll over. And I think this industry has shown time and time again its resilience and its commitment to its customers, to its business. And the brokers that I've been speaking to over the last 2 or 3 weeks have demonstrated to me that they are up for this, and the empathy they're showing towards lenders as well. So for me, to not do would be roll over. Stand up, look at your business, and really trying to find new ways in which you work, but deal with your existing, and to-dos would be to be speaking to your existing customers and understanding their circumstances at the moment, discussing payment holidays and looking at protection. There's one concern that I have is people cancelling their protection because it's a quick thing. They go through their bank statements and they look at what they can cancel. And I've seen through Mortgage Introducer and online that protection companies are now also offering payment holidays. And I think it is fundamental that brokers are having these conversations and making sure that customers are not cancelling on something they may well need down the line. So speak to them about protection. I think it's fundamental at this moment in time.
And Hans, what would be the one piece of advice you would offer to brokers to do right now and not to do right now?
I think I would focus on the pipeline. That's the to-do. The existing pipeline as it stands today, as new business, certainly from the specialist sector, has significantly declined for the time being, and possibly even from the big lenders, many of whom have withdrawn products from the intermediary introduced market, is the existing pipeline, the pipeline that's already there, especially, of course, the post-offer pipeline and the post-valuation pipeline, even if it hasn't been offered yet. That is the best prospect, of course, of continuing to generate a cash flow. So I think the do is focus on that and work it through. The don't is to lose sight of the bigger picture as you do precisely that. A classic and very simple example is, don't push your lender on completing on an offer for a buy-to-let portfolio landlord if that same buy-to-let portfolio landlord has asked for mortgage payment holiday on the loans he already has with that lender. Because we will not, for example, be completing on that loan. Because I don't really want to hand out a new loan to somebody who already is not paying me on all his other loans. So as you review the situation and as you work on your pipeline to try to get it through to completion and to the point that also, of course, delivers to you as the advisor, very important cash flow in these more constrained times, don't lose sight of the bigger picture. Use your commercial judgment, look at it in the round, so you make sure that you actually get those cases completed by working with your customers and the lenders. And so you can really focus on the loans that can be done.
And I would add to that. Sorry, Robin, I was just going to say that what Hans said, I've been doing a lot of work on those customers who have taken payment holidays and they've got existing loans that are still going through with us. And everyone, no word of a lie, every broker that I've spoken to understands exactly where we are coming from as a lender. And every time they've then spoken to their customers, the customers understand the position that we are in as a lender as well. And they haven't, going back to that, almost one of the first questions you asked, and I categorize them as the opportunists. And those people are well aware. I put my hands up. I didn't think of the bigger picture. So I think it's really important that brokers do have these conversations as much with these customers, and they're aware of everybody who's in this chain who's impacted by it.
And I would say, incidentally, just on this at this point specifically, we've seen a lot of incredibly helpful guidance put out by the broker community on this through the usual channels, LinkedIn, elsewhere, advising their customers and the public at large to be absolutely thoughtful about mortgage payment holidays and joining the scheme, and making sure that if they do look to join it, they have a genuine cause to do so. And we certainly appreciate that support.
Well, some solid advice there. I'm sure Will from Brightstar will be very happy. Now, finally, this is a global crisis and we are all in this together. What business advice would you give to those watching today? Grant?
For me, it'd be embracing technology. One thing that we have to react really quickly. I would go into Bracknell head office once, twice a week, just for meetings and so forth. Since we've started using Microsoft Teams, I'm probably going to have to go there once a month now. And that, to me, has transformed my productivity, the way in which I work. So the likes of Zoom, I'm using that to hold a number of conferences with brokers, with key partners, and that's transformed the way in which I work. And I think that more brokers should be looking at this as a tool to be carrying out their meetings with their customers, not necessarily looking at face-to-face. And I would say, look at your business. Now's a really good time to look at your business model. If something isn't working and you've questioned it for some time, now is a great time to react to that and deal with it, and to make sure that you're ahead of the game when you come out the other end. So look back at your business, look at where it's going and what direction you want to take it. Now is a great time to address that and embrace technology as much as possible. That would be mine.
Hans?
Yeah, I wanted to pick up on what you said. You said we're all in this together. And at the same time, I've been saying for about 14 times in the space of 46 minutes, how it's all about cash flow preservation. And cash flow preservation, one element of cash flow preservation, obviously, is to hold on to your money, not give it to other people. So how do we square the circle? I mean, we are all in business. A lot of us are in regulated businesses. We have some pretty draconian personal duties imposed on us by our regulator about the way we run our business, including from a prudential perspective, i.e., are we solvent? Do we have capital? All these very hard measures. And of course, that is our first duty. Our first duty is to the companies we run. But the minute we've established that maybe there is some leeway, it looks like the crisis is going to evolve in a way that is not going to put as much pressure on us as we anticipated, as we can start modeling with greater confidence, and therefore see that actually our resources are more ample than we anticipated. At that stage, we should be looking not just at what we can do for our own companies, but we should look at the other people in this value chain. And Grant was referring to that earlier. It's obviously not just the lenders who are put under pressure by the situation and the mortgage holiday scheme, payment holiday scheme. It's the brokers whose pipelines are shrinking dramatically as less new business is coming through, and as there are fewer lenders to place that with. It's surveyors, it's the legal service providers in this context. Everybody is going to suffer significant cash flow issues. Everybody may be losing around a quarter worth of cash flow. So to the extent that you find in your business that actually you're resilient and you've got cushion, let's think about how we can help each other. What business can we place? What business can we help you place so we stay in business and you stay in business? Whilst being very prudent, of course, with our cash, because that's what we all have to be in this situation. But let's look out for those other guys to the extent we have the capacity to do so we can all meet again when this is over and do business again and serve our customers.
Well, thank you, Hans, and thank you, Grant, and thank you at home for watching. Again, it's been both interesting and insightful in what are certainly strange, challenging, and uncertain times for us all. Well, that comes to the end of this webinar hosted by Foundation Home Loans in association with Mortgage Introducer, and I do hope all of you have found it as useful as we have. You can watch this broadcast again via various social media and also on the Mortgage Introducer website, which can be found at www.mortgageintroducer.com. I'm Robin Hall, Publishing Director of Mortgage Introducer. Thank you, keep well, and remember, stay home and stay safe. Goodbye.
Thank you all. Thank you for joining us. Thank you.
Thank you.